Hi, this is Zak Mir, editor of zaksta.com, with a look at some of the companies reporting next week. And I'm starting off with EasyJet, where it looks as though we're not going to see the shares drift much below the £12 level. 11.69 was the post-June support zone, and it looks as though we really had a rebound off the 200-day moving average, which is currently at £12.14. If you're aggressive and don't mind taking a punt before the announcement this week, you'd go long with an end-of-day close stop loss back below the 200-day line, or you'd wait for a momentum buy trigger, which would be an end-of-day close above the initial November gap top, which was at £12.83. So that's about 18 pence away at the moment. The upside is obviously a return towards £13.50 plus, maybe a little bit more, given that we've had the exhaustion gap to start this month. So reasonable prospects there for EasyJet going forward. Moving on to SABMiller, and we've got a situation here where there's been a decent attempt at recovery. The reason for that is that despite the despite the choppy price action, we've got an island bottom formation here for October. The right-hand gap remains unfilled, and the support coming in at and above the 50-day moving average at £31.59. The rather simple trade here should be to go long with an end-of-day close stop loss below that 50-day line and June support line combination. The target over the next 1 to 2 months would be the top of this year's price channel at £34. So it looks as though you'd be risking less than 50 pence to make £2 plus on the near term at SABMiller. On to JMAT, Johnson Matthey, and we've got rising trend channel from March, unfilled gap to the upside through the 50-day moving average, which basically gives us a bull flag situation, a sort of supercharged one. RSI 56 are also in the buying zone. I suppose what we have seen in recent times is setups like this ahead of a company reporting, and then this turning out to be a sort of the top of a gap to the downside or an island top. Obviously, there is a chance of that, but money management should deal with that. Basically, above the 50-day moving average at £29.24, we would be looking for a top of March price channel target as high as £32. So a couple of pounds of upside there, risking 50 to 70 pence on the downside. Slightly further down the market and intermediate capital, here we've got basically a sort of triangle formation. It should be a continuation formation as well to the upside. We saw a chart like this, similar chart like this on the on dollar yen recently as well. So as high as £5.50, maybe £5.30 if it's not quite doesn't quite sort of explode in the way expected. But really above the March support line of £4.60, we'd be looking for at least £5.20 or £5.30 over the next 4 to 6 weeks. If you're cautious, you would wait for an end-of-day close above the 20-day moving average at 481 as a buy trigger. Finally, we finish off with Mothercare, and here it's actually a surprisingly bullish-looking situation. We've had the one-touch test of the 200-day moving average at £3.73. Decent sort of consolidation at the floor of a rising trend channel from February, and the 50-day moving average at £3.94. And really, while there's no end-of-day close back below the 50-day line, where you would be looking for a return to at least £4.50, which is post-August support. If you're fussy, maybe you'd wait for a break of £4.20.22, which was August resistance, October resistance. But really, it looks as though the shares have done enough here to get to £4.50, and ideally for early next year up to £5.50, which is the top of the February price channel. That's it for me. See you again next time.